Hi everyone. Before I start this video, make sure you join my Discord server. The link is given in the description box below. Okay, so in this video, we'll be going over A-Level Accounting 2023 October-November Paper 4-2 question number 2. This is the structured paper 4, which consists of 2 questions. Each of them will be of 25 marks, and the total time limit given for this paper is 1 hour. Which means that ideally you should be spending about 1 hour in order to solve each question. And in this video as well, we'll be attempting to solve this question number 2 in under 30 minutes. So without any further delay, let's get started. Tea Limited manufactures a single product. The budgeted information for March is as follows. The selling price will be fixed at $20 per unit. March sales are expected to be 20,000 units. So these are the number of units sold in the month of March. Then there will be a 10% increase in sales volume in every month up to June, and the sales of subsequent months will remain at the sales level of June. Okay, let us first try and figure out the number of units sold from the month of March to the month of June. So that will be March, April, May, and June. And for the months after June, it will remain the same at the sales level of June. Okay, so these are the number of units for sales. And for the month of March, it's given to be 20,000. And we need to increase it by 10% in every month. So for the month of April, that is just going to be 20,000 times 1 plus 10%. This will result in the value of 22,000. We then repeat the same process for May, but now we have to increase this amount by 10%. So that will be 22,000 times 1 plus 10%, which results in 24,200. And for the month of June, we have to increase this amount. So that's 24,200 times 1 plus 10%. This results in the value of 26,620. And we are also told that the selling price will be fixed at 20 per unit. So let us also figure out the value of sales in dollars. So for the month of March, that is just going to be 20,000 times 20, which results in 400,000. For the month of April, that will be 22,000 times 20, which results in 440,000. For the month of May, that will be 24,200 times 20, which results in 484,000. And for the month of June, that is 26,620 times 20, which results in 532,400. Okay, we're done with the first information. Then credit sales are 75% of the total sales. Since we've already figured out the value for total sales, we can easily figure out our credit sales as well. So the credit sales is just going to be sales in dollar for every month multiplied by 75%. So for the month of March, that is just going to be 400,000 times 75%, which results in 300,000. For the month of April, that's 440,000 times 75%, which results in 330,000. For the month of May, that's 484,000 times 75%, which results in 363,000. And for the month of June, that's 532,400, which results in 399,300. Then 40% of credit customers will pay in the first month after the sale and receive a 5% cash discount. And the remainder of the credit customers will pay in the second month after the sale. Okay, so for our total credit sales, 40% will be paid in the month after. And in this case, we're also allowing a 5% discount. So the amount receiving in the month after is just going to be the total of our credit sales multiplied by 40%. And since we're also allowing a 5% discount, we need to deduct 5%. And then we were told that the remainder of the credit customers will pay in the second month after the sale. So the remaining 60% will be in the second month after sale. And the value for this is just going to be our credit sales multiplied by 60%. So if we're talking about the total of the credit sales in the month of March, credit sales, which is 300,000 times 40% times 1 minus 5% will be the amount received in the month of April, which is the month after. Then the remaining 60% of 300,000 will be received in the second month after, which will be in the month of May. Okay, we're done with the second information. Then the finished goods inventory level is budgeted to be 25% of the following month's sales volume. So this just means that our closing inventory units will be equal to 25% times next month's sales units. Then each unit requires 4 kg of direct material, which costs 1.5 per kg. The closing inventory of direct material is expected to meet 50% of the production requirement in the following month. So this is for our finished goods closing inventory. Now we're also given the criteria for direct material closing inventory. So for direct material, our closing inventory should meet 50% of the production requirement. So 50% times next month's production requirement. Okay, we're done with the third and fourth information as well. Let's have a look at our first question. We need to state 3 advantages of budgeting. So the very first advantage of budgeting is that there will be coordination among the plans of different departments, because all of the departments' goals will have to align in order to achieve the organizational goal. Let's write it down. Coordinate plans of different departments. Then the next advantage of budgeting is if we set the budget at a realistic level, then it can motivate our employees in order to achieve the common goal that we have set. So the second point will be motivates employees to achieve common goal. Okay, now for the third one, there will be responsibility accounting, because usually in case of budgeting, each department is given the responsibility to create a budget by coordinating with the remaining departments. So if the department is not able to achieve the target set as part of their budget, then they have to take a responsibility for it. So there is a responsibility accounting factor created by budgeting. Let's write it down. Responsibility accounting. Okay, that's for the first part. Now for the second part, we need to prepare the following budgets for each of the months of May and June. Okay, for the first part, we need to prepare trade receivables showing the opening and closing balances for May and June. This is for the month of May. And remember that we are preparing a trade receivables budget. The purpose of trade receivables budget is to figure out the closing balance of your trade receivables. So in order to figure this out, we always start with the opening balance. So that's our balance brought down. Then we need to add the credit sales, because credit sales give rise to our trade receivables. So the higher the credit sales, the higher our trade receivables value will be. Then we have to subtract the payments received for these credit sales. So these can be termed as our bank receipts. So any amount that we have received for the credit sales previously made, that is going to reduce our trade receivables. So that should definitely be subtracted. Then if we are offering any sort of discount, that will also reduce the amount that we are yet to receive from the customers, which means that the discount allowed should also be subtracted. And this will give the value for our closing balance of trade receivables. So we are just following the same format for our statement as well, which means we start with the opening balance. Let's write it down. So that will be our balance brought down. So we first have to look for the opening balance of May, and after we calculate the closing balance of May, that will be transferred to June as the opening balance. So let us look for our opening balance in May. So the opening balance in May will be the amount for credit sales made in the month of March and April that we are yet to receive. So remember that for the month of March, 40% will be paid in April, right? Which means that the remaining 60% will be paid in the month of May. So the 60% is yet to be paid, which means that 60% of this credit sales will be our opening balance of trade receivables. So this is just the credit sales relating to the month of March. Now we need to repeat the same process for April. For April, 40% will be received in the month of May. But we have not received any sort of payment in the month of May. We are just starting the statement for May, which means that the total amount of credit sales made in April is yet to be received. So this total should be included within our opening balance of the trade receivables. So we start with 60% of 300,000. This is a payment yet to be received for the credit sales made in the month of March. Then 330,000, which is the entire amount of credit sales made in the month of April, which is yet to be received. This results in the amount of 510,000. This will act as the opening balance of trade receivables in the month of May. Let's write it down. So that's 510,000. Okay, now the next thing that we need to write down is the credit sales that we made in the month of May as well as June. And we have already figured this out to be 363,000 and 399,300. So 363,000 for May and 399,300 for June. Then we need to subtract any of our bank receipts. So this heading will include all of the receipts that we get in the month of May and June for the credit sales made. Okay, for the month of May, remember we are getting 60% of the credit sales made in the month of March and 40% of the sales made in the month of April after allowing for this 5% discount. So the bank receipt for the month of May is just going to be 300,000 times 60% plus 330,000 times 40%, but we also need to incorporate the 5% discount. This will give the amount of 305,400. Now we need to repeat the same process for the month of June. For June, we will be getting 60% of the credit sales made in the month of April, and we will be getting 40% of the credit sales made in the month of May after allowing for a 5% discount. So that's just going to be 330,000 times 60% plus 363,000, which is the credit sales made in the month of May, times 40%, but we also need to incorporate the 5% discount factor. And this will give the bank receipt for the month of June to be 335,940. Let's write it down. For May, that's 305,400, which we need to subtract. And for June, that's 335,940. Then we need to include the discount allowed. Okay, for the discount allowed, we can refer back to our calculation for the bank receipt. Remember that in the month of May, we are allowing discount on 40% of 330,000, and the discount was of 5%. So in order to calculate the discount allowed amount for the month of May, we first need to calculate 330,000 times 40%, and the discount allowed was 5% of this value, so times 5%. Which results in the amount of 6,600. This is the discount that we allowed. Similarly, in the month of June, discount is being allowed on 40% of 363,000. Again, the discount rate is 5%, so that's just going to be 363,000 times 40% times our rate of discount, which gives the value to be 7,260. Let's write it down. So for May, that was 6,600. And for June, it was 7,260. Now we can easily figure out the closing balance of our trade receivables for the month of May. That's going to be 500 and... okay, there's an additional 0 here. So that's 510,000 plus 363,000 minus 305,400 minus 6,600, which results in 561,000. Now we need to transfer this amount as the opening balance in the month of June. So 561,000 right here. Now for the closing balance of the month of June, that's going to be 561,000 plus 399,300 minus 335,940 minus 7,260, which results in 617,100. So our closing balance is just going to represent the amount that we are yet to receive at the end of the month of May and at the end of the month of June for the credit sales made before that date. This completes the first part, and we're also given the working section. So in this section, you need to show your calculations for your credit sales, and you also need to show your calculations for the bank receipt, discount, as well as the opening balance of trade receivables for the month of May. And you need to do it so that you get your markings correctly. Now we can move towards the production in units. Okay, again, so the basic purpose of figuring out our production in units is just to calculate the units to be produced in each month. And in this case as well, I think we need to calculate it for the month of May and June. So in order to calculate the units to be produced, we start with the sales units. Then what we do is we subtract the opening inventory of that particular month. Then we add the closing inventory. This is the format whenever you have to prepare a budget in order to calculate the production in units. So we will be following the same format here as well. This is for the month of May. Okay, no wait, this is in units. And this is for the month of June. We start with our sales units. And this also we've already calculated before. So that is just going to be number of units. For the month of May, that's 24,200. And for the month of June, that's 26,620. Let's write it down. So 24,200 and 26,620. Then the next step would be to subtract the opening inventory and add the closing inventory. And we were given the criteria in order to calculate the closing inventory. So that's the criteria to be applied while calculating our opening inventory as well. Because remember that opening inventory is just the closing inventory of last month. So if you're looking at the opening inventory in the month of May, that is just going to be the closing inventory in the month of April. And the criteria that we were given is that our closing inventory should be 25% of next month's sales units. So while we're trying to calculate the closing inventory for the month of April, that is just going to be 25% of 24,200, which gives a value of 6,050. So that's going to be the opening inventory in the month of May. So our calculation for the opening inventory is just 25% times sales units. If you repeat the same process for the month of June, that will be 25% times 26,620, which results in the value of 6,655. Now for the closing inventory, that's going to be 25% times next month's sales units. So for the closing inventory in the month of May, that is just going to be 26,620 times 25%, which again results in 6,655. And this is as expected because the closing inventory of this month will be the opening inventory of the next month. Now we also need to calculate the closing inventory for the month of June, but we only calculated our sales units till the month of June itself. But the criteria given was that the sales of the subsequent months will remain at the sales level of June. So in the month of July as well, our number of units is 26,620, which means that the closing inventory for the month of June is going to be 25% of 26,620, which again results in 6,655. So the opening inventory and the closing inventory in the month of June is going to be same. And we need to subtract the opening inventory. Okay, now we can just calculate our units to be produced. For the month of May, that is 24,200 minus 6,050 plus 6,655, which results in 24,805. And for the month of June, that's 26,620 minus 6,655 plus 6,655. So this to just cancel each other out, which means that the units to be produced is just going to be equal to the sales units of 26,620. That's all for the second part. Now we need to calculate the purchases budget in dollars. And purchases is for the purchases of our direct materials. And we need to calculate it in dollars. Okay, so the main purpose of this budget is to figure out the value of the purchases to be made for the direct materials. And the format to be followed is again similar to the one we did for production. We start with the value of direct material required for the units to be produced. So the heading that we can use can be the production of current month. And in order to calculate the production of current month, we just start with our units to be produced, multiplied by the direct materials required per unit, and multiplied by the direct material rate per kilo. So in this case as well, we are given the criteria for this. So each unit will require 4 kg of direct material and the cost is 1.50 per kg, which means that in order to figure out the production of current months or the value for the production of current months, we just need to multiply the units to be produced by the direct material required per unit, which in this case is 4 kgs, and the direct material rate per kg is 1.5. Okay, then the next thing that we need to do is similar to that of our production budget. So we subtract the opening inventory, and then we add the closing inventory. We follow the same format here as well. Again, this is for the months of May and June. Let's start with the production of current month. Okay, so for the month of May, we have to start with the units to be produced in that month, which is 24,805 times 4 times 1.5, which results in the value of 148,830. We then repeat the same process for June. We have our units to be produced of 26,620 times 4 times 1.5, which results in the value of 159,720. Now we need to subtract our opening inventory and add the closing inventory. Again, the criteria for our closing inventory was given for the direct materials as well. There was 50% of the next month's production requirement. Okay, so if we are talking about opening inventory for the month of May is going to be closing inventory for the month of April. So the calculation should be 50% times current month's production. So that will just be 148,830 times 50%. So that will be 74,415. And for the month of June, that will be 159,720 times 50%, which results in the value of 79,860. And remember that current month's closing inventory will act as the next month's opening inventory, which means that the closing inventory for the month of May will have the value of 79,860. And the value for the closing inventory is just going to be 50% times next month's production. So for the month of June, we have to refer to the production in the month of July. But remember that our sales units was to remain constant after the month of June, which means that in July as well, our opening and closing inventory will be 6,655 and 6,655, and our sales units will remain the same, which means that our units to be produced for the month of July will also remain the same at 26,620. And if we multiply it by 4 and 1.50, the production of the current month for the month of July will still be 159,720, which means the closing inventory is going to be 50% times 159,720, which again results in 79,860. So the opening inventory and closing inventory for the month of June for our purchases as well will be the same like in the case of production. Now we can figure out the purchases of direct materials. For the month of May, that's going to be 148,830 minus 74,415 plus 79,860, which results in 154,275. For the month of June, that will be 159,720 minus 79,860 plus 79,860, which results in 159,720. That's all for our purchases budget. Now we're given additional information. During the budget committee meeting, the sales manager requested 100,000 for sales promotion for the existing product, and the production manager requested the same amount for research and development for a new product. Okay, the accountant reported that due to a financial constraint, only one of the requests could be allowed. We now need to advise the budget committee which request should be allowed. So the first request is to provide 100,000 for a sales promotion for an existing product, and the second request is to provide 100,000 for research and development for a new product. All right, this is of 7 marks, so we need to have 3 comments for each of the options. So if we provide sales promotion for an existing product, it means that it can increase the demand, which will eventually increase our revenue as well as profit. So sales promotion for the existing product can increase demand, which will increase revenue as well as profit. Similarly, this sales promotion can also promote the reputation of the company associated with that particular existing product. So can promote the reputation of the company associated with the product. And it will be particularly helpful if the product is at the declining stage. So if it's at a declining stage, it means that the demand for the product is going down. And if we put out a sales promotion, it means that the demand for that product might increase in the future. So product life cycle may be at the declining stage. Now we need to look at the research and development for a new product. So we said before that the sales promotion can increase demand, which will increase revenue as well as the profit. But we cannot say the same thing for research and development for a new product, because any financial benefit from a new product may not be realized for a certain period of time. So we have to invest first, and we have to wait for a couple of years in order to make any profit from this new product. Let's write it down. The financial benefits from a new product may not be realized for a period of time. Then the second thing that we can write down is that the success of any new product is uncertain. So we do not know whether or not this new product might be successful within our customers, and if it's not successful, the amount went for research and development might just go down the drain. So the success of any new product is uncertain. Then the next thing that we can write down is that by investing in a new product, the competitiveness of our business might be ensured within the industry. So new products ensure the competitiveness of the business in the future. Okay, now based on these factors, we need to advise the budget committee. So I'd personally advise the budget committee to allow for the request for funds for research and development for a new product, because the company should always aim for new products so that they can keep up to the customers' changing tastes. Let's write it down. The budget committee should allow the request of funds for research and development of a new product, as it is very important for the business to keep up with customers' changing tastes. Okay, that is all for this question. And if you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.